There is a specific dollar amount embedded in federal law right now, and the moment your checking account surpasses it, a report is automatically submitted to a federal agency. No notification, no advance warning, no call from your bank. It simply occurs. And the most concerning aspect is not the report itself. The most concerning aspect is what most individuals do the moment they discover that number exists, because that one impulse, that one action that feels like safeguarding, is a federal felony. My name is Scarlett. I create videos like this every week to assist you in safeguarding your money and comprehending the regulations nobody gives you an instruction manual for. If that sounds beneficial, subscribe. There's significantly more arriving. Here's the number. Under the Bank Secrecy Act of 1970, all financial institutions in the United States, all banks, all credit unions, all savings and loans are obligated by federal law to submit a currency transaction report to the Financial Crimes Enforcement Network, known as FinCEN. Anytime a customer conducts a cash transaction that exceeds $10,000 in a single business day, that report is submitted on FinCEN, Form 104. It comprises your complete legal name, your social security number, your date of birth, your home address, the precise amount, and the time it occurred, down to the minute. The bank has 15 calendar days to submit it. You will never obtain a copy, and the bank is legally restricted from informing you it happened. That's the guideline under 31 United States Code Section 5313. I want to be specific about what actually triggers this, because individuals get confused here. This guideline concerns cash physical currency, and in particular cases, cash equivalent instruments like money orders and cashier checks. It is not triggered by a standard check you deposit, a typical wire transfer, or your Social Security direct deposit arriving in your account. Those routine electronic movements aren't what this guideline is designed for. And one additional detail that surprises individuals: the bank combines your cash transactions across the complete day. Depositing $5,000 at one branch and $6,000 at another branch that same afternoon still totals $11,000 in the bank's perspective. You cannot circumvent the threshold by splitting locations. Now, here's what individuals get incorrect in both directions. If you're a modest income retiree, your deposits may seldom approach $10,000, and that seems like protection. It isn't. I'll demonstrate why in a moment. If you're a retiree with significant savings, you may be transferring money between accounts, obtaining pension disbursements, or consolidating accounts following a spouse's death. And all of those instances are potential concerns. Both groups can proceed fully safeguarded. I'm going to clarify exactly how. For each one, a currency transaction report by itself is not a charge. It's mandatory documentation. Millions get submitted every year, and the vast majority trigger absolutely nothing. The issue isn't the report. The issue is what happens afterward. And that leads directly into the second guideline almost nobody discusses, because $10,000 isn't even the number you actually must be concerned about primarily. The genuine number sits underneath it. There's a second type of report banks submit, and this one has no dollar ceiling at all. It's called a Suspicious Activity Report, a SAR, and a bank can submit one on a transaction of any size, $2,000, $500. There is no minimum. The determination comes from the bank's internal compliance software examining your transaction history for patterns, not crimes, patterns, and the pattern that activates a SAR fastest is a collection of deposits that combined would have surpassed $10,000. Anything that seems intended to circumvent the reporting requirement. Consider a woman named Diane. She's 67, a retired registered nurse outside Nashville. She sold her vehicle for $11,000 in cash because the buyer didn't have a cashier's check that day. Diane had heard somewhere that $10,000 was some kind of governmental threshold. So she deposited $5,000 on a Tuesday and $6,000 on a Friday. Two distinct occasions, her personal money, a completely permitted sale. The bank's software observed two substantial deposits in 1 week from an account that had previously contained no more than $3,000, and it submitted a SAR with FinCEN. Diane accomplished nothing improper, but that report now resides in a federal database, cross-referenced against all her subsequent activities. Here's the element that costs individuals the most. The bank cannot inform you a SAR was submitted. A bank employee who informs you commits a federal crime called tipping off, punishable by up to 5 years in prison. So, the secrecy isn't an accident, it's the law. And that leads directly into the most concerning part of all this, because once individuals understand the $10,000 guideline, they all have the identical impulse. That impulse is a felony. Pause for a moment and examine your actual checking balance, not previous month's statement, today's figure. Keep that in consideration, because everything from here is applicable directly to it. When individuals hear about the $10,000 reporting guideline, the initial reaction is generally the same. Maintain deposits underneath it. Distribute it a little today, a little the following week. That reaction is not a solution. It's a federal felony called structuring. Under Title 31, U.S. Code, Section 5324, it is prohibited to divide or facilitate dividing any transaction with the objective of circumventing the currency transaction report requirement. You don't need to be engaging in money laundering. You don't need to be committing deception. If all your money is completely legitimate, acquired, inherited, presented as a gift, and you deliberately deposit it in lesser portions to remain underneath $10,000, you've perpetrated a federal violation. The consequences are harsh. Under $100,000 in a 12-month interval, up to 5 years in federal prison, and up to $250,000 in penalties. Beyond $100,000 related to additional criminal activity, up to 10 years. And in all situations, the administration can confiscate the money through civil asset forfeiture prior to any verdict at all. The responsibility then rests on you to demonstrate the money was legitimate. And as you're demonstrating it, the money is currently unavailable. This isn't hypothetical. A federal oversight body, the Treasury Inspector General for Tax Administration, examined a collection of these structuring seizures and discovered that in the situations where structuring was the stated justification for the seizure, the predominant majority, more than 9 out of 10, included money that had been acquired entirely legitimately. The law was designed to apprehend narcotic dealers and cash smugglers. In implementation, it was predominantly affecting regular, law-abiding account owners. That widespread disapproval initiated genuine modifications. In 2015, the IRS proclaimed it would discontinue confiscating legally sourced money in the majority of situations. And in 2019, Parliament constrained the IRS, specifically from confiscating accounts on structuring doubt unaccompanied when the money originated from an authorized resource. But those modifications apply to the IRS. The Department of Justice is able to continue pursuing these matters, and structuring itself is still thoroughly a crime in existence. The guidance hasn't shifted. Never partition a transaction to circumvent that boundary. Here's who encounters this most regularly. Retirees who obtain unscheduled substantial individual payments rather than ordinary paychecks. A terminal pension settlement, a mortality insurance payout, earnings from disposing of a residence or a vehicle, a bequest, a delayed Social Security allocation that comes all simultaneously. These aren't affluent individuals performing anything unconventional. They're cautious individuals whose compensation comes in sizable, sporadic quantities that seem atypical to algorithms constructed to identify offenders. And you will never be notified any of this took place in the immediate moment. It's also important to comprehend why retirees specifically get flagged with higher frequency than employed age account owners. When you held a job, your finances predominantly shifted in one consistent configuration. One paycheck electronically transferred, identical quantity, identical timing. Retirement finances doesn't function that manner. You might have Social Security arriving on one moment, a pension on another, investment earnings on a subsequent one, and then placed underneath all of that, occasional sizable one-moment situations, a required withdrawal, a residence disposition, a settlement. Computerized observation frameworks are constructed to identify alteration, and a retiree's monetary circumstances is normally more heterogeneous than an individual stable paycheck. Furthermore, a significant number of retirees no longer possess an accountant or specialist positioned beside them the manner they could have throughout their employment phase. So these circumstances accumulate gradually, uncontrolled, until one of them generates a genuine concern. Nothing of this indicates something is faulty with how you're managing your finances. It simply indicates the framework was created for a distinct, more consistent design than the one retirement finances genuinely operates. There's furthermore a wider context worth comprehending. The Bank Secrecy Act was created in 1970 to battle cash smuggling and syndicated transgression, and it was broadened substantially following 2001 under the USA Patriot Act to encompass extremism money movement. The framework was constructed to apprehend offenders. It was not ever meant to concentrate on retirees, but the algorithms monitoring your accounts isn't conscious of the discrepancy between a grandmother relocating her personal finances and somebody relocating criminal money. Both designs can seem identical to a formula. Documentation is what separates them apart. And to be precise about what a CTR submission genuinely represents for you, FinCEN aggregates the submissions, and the IRS is able to retrieve them throughout an investigation if several additional individual justification for doubt previously is present. A CTR by itself is not an investigation spark. It's a component sitting in a framework that just matters if something different directs investigators to it initially. So, here's what I want you to perform. The allowances, the opportunities, the reimbursements, most retirees currently qualify for, but never request. I've gathered them all in one location, state by state, document by document, so you don't invest periods exploring administrative portals. Everything's arranged simply and straightforwardly, so any retiree is able to discover everything that pertains to them. Regardless of what location you're in, there is compensation you're leaving unrecovered. It's named the Senior Exemption Playbook. It's in the initially anchored statement directly underneath this presentation. Simply select it once, and you'll possess all you require. Now, continue positioned here because the upcoming component is the individual most significant safeguard most retirees never implement, and it's the rationale I produced this complete presentation. The safeguard isn't avoidance, it's documentation and candor. That's the solitary element dividing a typical CTR submission that disappears from a genuine difficulty. Consider a woman named Sylvia. She's 71, a retired elementary school principal from Baton Rouge. Her brother deceased and gave her $38,000 from his inheritance. She proceeded into her financial institution, submitted the complete quantity in one moment, presented the teller a photocopy of the inheritance settlement communication and the testament identifying her as inheritor, and inquired the teller to document the foundation. A CTR was submitted. Sylvia never obtained another statement concerning it. The documentation guaranteed that. That's the concept. Submit the complete quantity in one moment. Provide documentation that identifies the foundation, a bill of trade for a transportation, a present notification from your kid specifying the quantity, the moment, and that it's a present with no recompense anticipated, an inheritance settlement notification, a pension recognition notification, a Social Security notification of allocation. Maintain a duplicate. You'll probably never want it, but in the case the inquiry ever emerges, you present the information rather than rushing for one. There's much more to defending yourself here than the submission itself, and this is where I want to incorporate a number of items that don't obtain spoken about sufficiently. One beneficial activity is maintaining your finances in distinct sections rather than managing your complete monetary circumstances by way of one checking financial institution. Your checking financial institution should genuinely merely maintain 1 to 2 intervals of living expenses, plus a minimal emergency fund. It's your container, not your repository. A distinct elevated percentage savings or monetary marketplace, financial institution FDIC covered, is an improved destination for your 3 to 6 interval emergency allocation, and it genuinely compensates you something, rather than remaining at a fractional percent while inflation quietly consumes it. Finances you will not contact for a period or longer can function more challenging, still in items like temporary governmental obligations or CDs. Further than maintaining your finances tidier and significantly less concern-prone, this arrangement fixes a subsequent quieter concern. Non-productive finances in checking is destroying legitimate cost every interval. It merely remains positioned. In case you're 73 or more mature and obligated to obtain a minimal allocation from a conventional retirement account or 401k, numerous individuals obtain the complete item as one solitary sum in December and position it immediately into checking, which is precisely the type of solitary substantial submission that gets noticed, if your contract permits it. Obtaining that allocation in tinier recurrent quantities across the interval is not structuring. Structuring implies breaking up a submission specifically to prevent a statement. A recurrent standard allocation configuration for organizing purposes is completely appropriate. The distinction is objective, and a recurrent ordinary removal seems nothing like somebody attempting to keep something hidden. Kinship presents concern here as well. There's a per-year present financial restriction, $19,000 per individual per interval for 2026, that you can present or obtain without triggering a present financial submission. Move beyond that sum and you're normally expected to complete document 7009, not essentially to compensate, merely to mention it. Sizable, unrecorded movements connecting relatives are specifically the circumstance that grows an issue in the circumstance your financial institution ever obtains a moment assessment. So maintaining a straightforward documented log safeguards you in all directions. Couple supplementary items value comprehending. Initially, a solitary elevated earnings interval, a sizable pension financial account removal, a Roth exchange, an inheritance, disposing of a leasing residence can force up to 85% of your social protection allocation into chargeable region. And distinctly, it is able to initiate ARMA A, the earnings attached modification that expands your Medicare component B and D settlement costs 24 intervals subsequently, depending on that interval's earnings. Individuals obtain one sizable deletion, disregard it, and receive amazed by a more substantial Medicare cost intervals afterward. Distributing sizable earnings circumstances across monetary intervals, whenever you possess the capability, silently defends you on all angles. Afterward, in case you're currently employing platforms including Venmo, PayPal, Zelle, or Monetary App to buying things or obtaining finances from relatives, recognize that action is able to create its own financial documentation. And in case those platforms supply immediately into your principal checking financial institution, it all intermixes into the comparable visuals the observation frameworks are viewing. That doesn't suggest discontinue utilizing them. It suggests maintain that action as organized as all the remainder. Here's your action strategy. Phase 1. Prior to you submitting any sizable sum, assemble the text that substantiates wherever it commenced: the bill of trade, the inheritance notification, the present notification, the pension recognition. Phase 2. Submit the complete sum in a singular moment. Constantly avoid dividing it among intervals or branches. Phase 3. Present the foundation documentation to the teller in individual and inquire them to document it on the submission. You're permitted to do this and it guards you. Phase 4. Continue a individual file, physical or digitally archived, of all supporting documentation for any submission beyond $5,000. Phase 5. In case you're transmitting your personal finances, connecting financial institutions, or ending one following a passing, execute it as a singular digital settlement with a notation section clarifying the reason, and continue both confirmations displaying the identical moment migration. Phase 6. Consistently, underneath any situation, partition a submission or removal into smaller sized portions to continue underneath $10,000. a sizable, legitimate submission is appropriate. Trying to escape the statement is the solitary thing that's genuinely concerning. One supplementary thing prior to you depart, because I consider it's the many reassuring component of all I've addressed this moment. Nothing of this suggests you must maintain finances at residence to prevent the monetary framework entirely. I appreciate the charm. No financial institution, no submissions, no mechanism viewing, but that's a negative commerce. Finances remaining in a residence isn't covered. In the circumstance of a conflagration or a taking, it's merely absent, with no mechanism to retrieve it. Sizable quantities of finances are able to generate their individual lawful difficulties, in case you're at any moment questioned, to display wherever they originated. And similarly to non-productive checking balances, finances at residence destroys legitimate cost to rising rates every interval while gaining you nothing. The response wasn't to keep your finances concealed, it's to structure it. Organized approach beats concealment continuously. Your financial institution is not obligated to describe any of this to you, and it is not permitted to advise you following the fact either.